After I became an enrolled agent, guys, I promise you, I felt so lethal. Like I felt like I had tapped into a second being. But it wasn't until I met someone who was a real estate investor that changed everything in what I'm doing. When I met this guy, it was on a Monday, and he came into my office. He was wearing like board shorts. He was literally wearing like board shorts, flip-flops. He had one child with him, and his hair was just like all musty and stuff like that, like musty, dirty blonde hair. Like he had literally just woken up from the beach. And he came into my office and he sat down with me, and he just seemed like he just had this super cool demeanor. Like someone you want to be friends with, but like you don't know them yet, but like he seems pretty cool. So when I started talking to him, I asked him like, why did you schedule a consultation with me today? What are we looking to get accomplished? That's pretty much how I start every call. What are we looking to get accomplished? And he's like, honestly, I just want to make sure I'm not like overpaying anywhere. I just want to make sure I'm still good. Like I normally don't pay taxes. I just want to make sure I'm still good. I see your guys' videos and stuff that you guys are doing online. I just want to make sure I'm still good. So he was just coming in for like a checkup. So that's what he was coming in for. So I opened his tax returns and I realized, okay, this guy's making around 2 to 3 million a year, but he's not paying any taxes. And I asked him, I was like, do you have another copy of your returns? And I went back to his returns in the previous year, same thing, 2 to 3 million a year, no taxes. And then he's like, I can email you my other ones. Same ones. Let's just say 2016 tax returns, 2 to 3 million, no taxes. I'm like, wow, this guy is making 7 figures every single year, and he's not paying any taxes. What is it that he's doing that other people are not doing that is allowing for him to pay 0% in income taxes? And then I started studying his returns, and I realized that this guy had rental properties, okay? He didn't just have one rental property, he had 14. And these 14 rental properties were giving him enough depreciation that he was not paying any taxes on the money that was flowing over from his LLCs or from his S-corp or from the W-2 income that he had. 0. 1 year, 0 taxes. The next year, 0 taxes. The next year, 0. It was like a game to me where I was just like seeing this. I'm like, how is he doing this? And I started to really realize that depreciation might just be the most important tax benefit that we have as entrepreneurs. Now, how many of you guys in here own an investment property? How many of you guys? Okay. So there's about like 7 or 8 of you guys that own investment properties. How many of you guys plan on owning investment properties? Okay, all of your hands go up. When most people say, do you want to own an investment property? You're going to say yes. Why? Because you know in your heart of hearts that owning investment property means wealth or wealth creation. If I start buying assets that pay me over the course of time, I'm building wealth, and God forbid something happens to me, my children get it. Like you know those things, right? So if someone tells you, hey, I can teach you how to buy real estate and never pay taxes, your ears are going to perk up a little bit, right? They're going to perk up a little bit. So what I decided to do was I decided to focus on becoming a real estate tax strategist. The reason why is because I can show anybody, whether you're W-2, 1099, crypto, stock, day trader, how to avoid 100% of your taxes with owning an investment property. Now, I want to explain how this all works because it was pretty weird to me when I was studying the tax returns and I couldn't figure it out. There are some rules involved, and we have to understand the rules. Part of the reason why I'm good at what I'm good at is because I'm good at simplifying very complex things. So I'm going to take something that's extremely complex and simplify it for you guys today. Back in 1987, there was called the Tax Reform Act. Do you guys remember who was in office in 1987? Reagan. Okay. Reagan implemented the Tax Reform Act. What the Tax Reform Act did was it created 2 different buckets. It created a passive bucket and a non-passive bucket. Let me ask you guys a question. Is Airbnb subleasing a passive business or a non-passive business? Non-passive. It's non-passive. Is owning an investment property a passive business or a non-passive business? Non-passive. Or sorry, it's passive, correct? Passive. Good. Good. So W-2 taxpayers who are earning good income previous to 1987, and even 1099 taxpayers who are earning good income previous to 1987, were purchasing investment properties strictly for depreciation to offset their W-2 and 1099 income. So let's just say husband and wife who's a doctor in 1987 are making $250,000, which is a lot of money in 1987. They decide to go buy a couple of investment properties in Arizona or Tucson, and then they avoid 100% of taxes on their W-2 income. Whether the property is being managed by them or not, they're able to buy real estate and avoid their non-passive income, their W-2, their 1099, etc. What the government said after 1987 is real estate is being used as a tax shelter for W-2 income taxes. We need to establish some rules here where if you invest in real estate, you should not be able to use your passive losses from real estate to offset your non-passive income, your W-2, your 1099, your stock, your crypto, your whatever. So what this means is if I had investment properties that I was holding on to that were helping me avoid taxes previous to 1987, I can no longer use real estate as a means to offset my W-2, my 1099. We have to understand why the government did this. When you buy real estate, you're buying something that's extremely big. There's two different things that we're purchasing when we buy a property. We're purchasing the land and we're purchasing the building. When you decide to place a property into rental purpose, the government will allow for you to write off one of these items. Which one do they allow you to write off? The building, okay. They allow you to write off the building. Now, what is the time period? Do any of you guys know? What is the time period that we're allowed to write off a building over? 27.5. Okay, 27 years. Guys, I'm 29 years old. 27 and a half years is a long time. Wouldn't you guys agree? Yeah. Okay. So let's just say this property that you and I found is a $1.5 million property. I'm going to use a bigger number so it's easier to understand. So we find a $1.5 million property in Bakersfield, California, Airbnb. And the building, they tell us when we close on the building, Karlton, the building is $1 million. The land is $500K. Okay? That's what gets us our 1.5 million. The land for tax purposes doesn't matter to us because we can't write it off. The 1 million does. So we take this 1 million divided by 27 and a half to get what our write-off is over the course of time, which would be $36,363. So that would be our write-off every single year for 27 and a half years. Okay? So if I had no rental income coming from this rental property and I just claimed depreciation on my tax returns, I would have a $36,363 loss that works against whatever other income I might have. So if I had $100,000 of W-2 income, I get to subtract $36,363 from my taxable income. Now, what I like to do with the investment properties that my customers own or that I own is I like to alter this amount that I'm taking in the first year. The reason why I want to alter the amount that I'm taking in the first year is because if I can create a big enough loss on the tax returns, can I just offset all of the other forms of income I might have W-2, 1099, LLC, S-corporation. So the cost segregation study, which I want you guys to write this down, is the tax strategy that I use to accelerate depreciation on an investment property. So I'm going to explain what that means. The cost segregation study is a strategy that I can do on an investment property to alter this number that I'm taking in the first year. We're inside of an investment property right now. How many of these items that you guys see do you feel like are going to last 27 and a half years that I'm going to yell out right now? Windows, appliances, cabinets, lighting, electrical, HVAC, plumbing, floor, roof. We start to realize that a lot of the components that make up an investment property actually don't last 27 and a half years. We're just writing them off over that period of time, okay? The wealthy know strategies that can allow for them to avoid their taxes. This one being one of them. What they're gonna do is, rather than waiting this period of time to write off items that they know don't even last this period of time, they're gonna segregate the components out of this building and get the cost associated with them. When you get the cost associated with those components, a study has been done that allows for you to write off these components in a quicker amount of time. Let's say we're writing off a lot of this stuff in year one. If I were to write off $1 million in year one, that'd be a sizable tax deduction, right? That'd be huge, it'd be epic. But the government's not gonna allow for me to write off the entire building's amount in 1 year, because they realize, a property is not gonna fall over in 1 year. So you can't possibly write off the entire building in 1 year. But they are gonna let me segregate all of the components outside of the building's structure, okay? So when I think about properties being built, if you guys ever gone down like a new construction road and you see properties being built, what do you normally see? Just like the wood, right? The wood, the actual structure, that is what makes up the house, okay? Everything else is considered addition. That addition we can accelerate. And on average, the addition is 30 to 40% of your building's value, okay? So I had a customer in a similar situation with a $1.5 million property, very similar figures that we're talking about here. After he wrote off everything he could possibly write off, we got down to this strategy called the cost segregation study. And the cost segregation study allowed for me to accelerate 30% of his building's value in 1 year, creating a $300,000 paper loss on his tax returns. Now, let's go back up here to these rules that we were talking about, because I didn't forget about this page. 1987, we said that the government created these passive activity loss rules. So we can't even use these negative 300,000 that Karlton just created on the tax return. So I just created a huge paper loss for nothing, unless you understand how to unlock these losses. You start to realize this is starting to become a game for me, huh? All right? Once I started figuring this stuff, I'm like, dude, it's like football to me. If I could just understand how to unlock this stuff, we're gonna win the game. Perfect. So how do I unlock passive losses? If I have a passive business that's over there, how do I get it to offset like my non-passive income, my W-2 day job, 1099 income? How do I get to do that? Here are the rules that the government created in 1987 that we're gonna learn. If you wanna use your rental losses, number one, you have to make less than $100,000 adjusted gross income. This was the first thing they said. So if you want to be able to use your rental losses, sure, Taxpayer, I love the idea of using rental losses. You need to be making less than $100,000 if you want to be able to use rental losses. How many of you guys are striving to make more than 6 figures are already doing so? Right? Come on. Right? So that disqualifies a lot of us, doesn't it? Kinda. Yeah. And if you're making less than $100,000, you're only limited to $25,000 in losses. Okay? So this was the very first rule that they said. If you want to be able to use passive activity losses, your AGI needs to be 100K or less, and you're only able to use up to $25,000 in losses. Rule number 2, they said, is if you want to use your passive losses, you have to dispose of your property.
What?
You mean that I have to sell my property? If I do those strategies that Karlton said, that means that I won't have or if I sell my property, I won't have a property anymore. If you dispose of your property, you're able to use the losses to avoid the capital gains from the sale. But now we're without an investment property. Why would I want to get rid of my property though? Now I don't have a tenant that's paying me, right? And the third rule was, if you qualify as a real estate professional, REP, qualify as a real estate professional.